Attendees are in listen-only mode.
Hello everyone, and welcome to the second in our series of webinars focusing on expatriate tax and global mobility issues. This webinar today will be presented to you by myself, Charlotte Firth, and my colleague, Charlotte Hoborough, and we work for United Tax Network UK. So just for anyone who didn't listen to our first webinar, a bit of background on the United Tax Network. This is a network specifically for global mobility and expatriate tax issues. There are contacts in 100 countries, and each country specialises in international tax issues and helping companies to move their employees around the world. If you're interested in the core services provided by UTN, you can find these on the UTN website. And during today's webinar, you will have the ability to ask questions, so please feel free to pop over any questions you have and we'll answer them at the end. Today's topic is overseas workday relief. This relief is relevant to inbound individuals who are not domiciled in the UK, so broadly those who don't consider the UK to be their long-term home, and who spend part of their time working in the UK and part of their time working overseas. This is a relief for employees coming to the UK, which can allow them to exclude some of their remuneration from UK tax if they meet certain conditions and follow certain rules. These rules can be quite complex, so it's very important that you seek professional advice beforehand to ensure the relief will be allowed. And the relief is generally only allowed for the first 3 years in the UK.
As Charlotte has mentioned, there are criteria that the individual must meet to be able to claim the relief. The first criteria is that the individual must be non-UK domiciled, and we will discuss this a little bit more in a minute. The second criteria is the individual must be taxed on the remittance basis. They also must be working partly in the UK and partly overseas. And the tax year that they claim the relief must either be the first tax year that they're resident in the UK, and this can be a part or a full tax year, or one of the following 2 tax years. A non-domiciled individual is someone who doesn't consider the UK to be their long-term home, so usually they'll eventually be looking to retire or move back to the country that they were born in. However, it is important to mention that domicile can be a complicated topic, so if someone is unsure of their domicile, they should always seek professional advice before claiming this relief. As I said, the individual must also be taxed on the remittance basis for the tax year that they're claiming the overseas workday relief. The remittance basis is a basis where the individual's overseas income and gains are not taxed in the UK as long as they do not remit the income and gains to the UK. How the relief works? Well, the foreign earnings, that's the earnings which relate to the duties performed overseas. These foreign earnings are not taxable in the UK as long as this income is paid directly offshore into an overseas bank account, and the earnings are then not remitted to the UK, either in the tax year of the relief claim or in any future tax years. A workday that the relief can be claimed for is usually considered an overseas workday if the individual has spent 3 hours or more working overseas on that particular day. They can include weekend days if they've been working overseas during the weekend, or if they've actually spent some of their weekend travelling to overseas meetings.
So from Charlotte's overview there, you can see that the relief could potentially be very beneficial for some employees who are working partly overseas. However, there are quite a few issues that you would need to consider before making a claim for the relief. The first issue relates to the overseas bank account itself. The remuneration relating to the overseas work days needs to be paid directly into an offshore bank account and not then remitted to the UK in that tax year or any future tax year, as Charlotte's mentioned. This bank account needs to be an account that qualifies as a special mixed fund account in order for all of the remittances and offshore transfers during the year to be treated as a single remittance at the end of the tax year. This can be much more useful in practice than using the normal rules requiring analysis of each remittance during the year. So to be a qualifying account for the special mixed fund rules, the account either needs to be a new overseas bank account or alternatively a bank account that's already held but with a balance of no more than £10 on the day that the first deposit of qualifying earnings from that employment is made into the account. Then either 100% of the remuneration or the amount that relates to the offshore duties must be paid directly into that offshore account and not go through a UK bank account first. If 100% of the remuneration is paid offshore, then you can then remit to the UK the amount of remuneration relating to the UK workdays at a later date.
The relief is claimed through the tax return after the tax year has ended, but for practical purposes, a Section 690 application can be made to HMRC. This is advantageous for cash flow purposes because this application allows for a certain percentage of your remuneration, and that's based on the estimated amount of overseas workdays the individual is going to be working overseas. This amount of remuneration can be paid offshore gross, in other words, without deduction of tax. This means that the individual then receives the relief throughout the tax year rather than having to wait until they claim in the tax return. This application doesn't have to be done, but obviously it can be advantageous depending on the individual's circumstances.
So another point to consider is the potential restriction of relief. And this can happen in several cases. At the end of the tax year, calculation needs to be done to work out how much relief can be claimed. The relief must then be restricted to the lower of the number of days worked overseas or the amount actually paid offshore. So to maximise the relief, it's important to make sure that enough remuneration is paid offshore during the tax year. If a special mixed fund is being used to allow an annual calculation, then you can make a catch-up payment in March, so the last month of the UK tax year, if you find that not enough money has been paid offshore during the tax year.
Another important issue to consider with maximising the relief is whether the employee is receiving any benefits, because overseas workday relief can also be claimed against benefits, not just cash remuneration. As benefits are not cash payments that usually do not go through payroll and are reported on a P11D at the end of the year, in order to claim the relief against these benefits, an additional amount of cash would need to be paid offshore throughout the tax year in order to claim the relief on the benefits when the tax return is filed. If an additional amount of cash is not paid offshore to cover this, then usually the benefits will not be eligible for overseas workday relief and tax will need to be paid on 100% of these benefits.
Another point to consider is cash flow. So the employee's cash flow and financial situation should be considered beforehand. For example, if the employee needs all of their remuneration in the UK in practice in order to pay rent or school fees or other items, then it might not be possible or indeed practical to claim the overseas workday relief in the first place.
Eligibility in future. We've already talked about the fact that overseas workday relief is normally claimed for the first 3 tax years that an individual is in the UK for. Overseas workday relief can be claimed again if the individual leaves the UK and then returns at a later date. So, for example, the individual can claim the relief for 3 years. They can then leave the UK. As long as they are then non-resident in the UK for 3 consecutive tax years, they can then return to the UK and claim the relief again.
Another factor to consider is bonus payments, which can be a further complication. So if a bonus payment is made in a year when the employee is no longer eligible for overseas workday relief, they may still be able to use overseas workday relief for that bonus if the bonus itself relates to duties performed in a year when they were eligible for overseas workday relief. If that's the case, then the portion of the bonus payment that relates to the overseas duties would need to be paid offshore and then not remitted to the UK, and the relief can be claimed on the tax return.
Another very important issue to consider is remittances. We've already discussed the fact that the remuneration relating to the overseas workdays must be paid offshore and not remitted to the UK if the relief is to be claimed. It's very important that the individual is aware that a remittance is not just a physical transfer of money to the UK. A remittance can actually cover lots of different things, including paying off a UK credit card using overseas funds, and also buying an asset with overseas funds and bringing the asset to the UK. So it's important the individual realises this so that they understand the remittance rules and they don't inadvertently remit money relating to the overseas workday relief and then obviously jeopardise the relief.
So I'd just like to take you through a couple of recent client cases so you can see the practicalities of the relief in action.
We had an individual who came over to the UK and based on the anticipated number of days, midnights in the UK, the individual appeared to be non-resident for the tax year. We're not going to cover residence rules in this webinar, but residence is usually based on days spent in the UK in a tax year along with ties to the UK. Now this individual, based on the number of days they anticipated they were going to be in the UK for, they were going to be considered non-resident. Now an individual who is non-UK resident is only taxable on remuneration relating to UK work days, regardless of whether the money that relates to overseas days is paid offshore or not. So we advised the individual that they did not need to pay any money offshore. They could have full use of the money in the UK, which is obviously advantageous from a cash flow advantage, but they would still only pay tax on their UK workdays income. However, the individual changed their plans towards the end of the tax year and they ultimately ended up spending more time in the UK than they anticipated. They exceeded the maximum number of days allowable for non-residents and they actually became resident in the UK for that tax year. However, the individual, now they were going to claim overseas workday relief because they were resident, they could actually only claim overseas workday relief on remuneration going forwards from the date the change in resident status was realised, because overseas workday relief, as Charlotte has previously mentioned, can only be claimed once a qualifying bank account is set up and the first deposit of qualifying earnings is paid into the account. So the individual was not able to backdate the overseas workday relief to the beginning of the tax year, and this meant that they ended up paying more tax than they had anticipated. So detailed planning around residence and anticipated number of days in the UK is crucial to ensure maximisation of tax relief.
And another client case we had recently, also relating to bank accounts. This client was resident in the UK for the tax year, and for the full tax year from the outset they were working both in the UK and overseas. However, this client only set up their qualifying offshore account, in this case it was a Jersey account, in June of the tax year. So overseas workday relief could only be calculated and claimed for the period from July to March for their salary payment, and then for the period July to December for the calendar year bonus that he was also paid. So in that case, the qualifying bank account did have a big impact on how much relief could be claimed. So we're now going to move on and see if we've got any questions. The first question we've got through says, I have an employee that arrived in the UK in March 2018. Does that mean that the 2017-18 tax year is the first tax year for overseas workday relief?
That's a really interesting question because it relates again to the maximisation of the relief. If someone arrives towards the end of the tax year and they are indeed resident in that tax year, then that tax year would count towards the first year of overseas workday relief. So if the individual arrived in March 2018, the first tax year they would claim the relief would be 2017-18, and then they would get 2 more years following this. But in actual fact, they're then only receiving just over 2 years of the relief. We had an individual who planned their arrival here to maximise the relief, so they arrived just after the 6th of April, and then they received overseas workday relief for that first tax year and then the following 2 tax years, so they actually received 3 years of relief. So the arrival date, if it's practical, it can be a good idea to try and plan that arrival date to ensure maximisation of the relief.
The next question is, if the money is paid into the offshore account, I would assume that it will be taxed in that country, even though the individual might not be tax resident in that country. That's also an interesting question, and one we see comes up quite a lot. So if the money is not taxed in the UK, it's true, it doesn't necessarily mean that it won't be taxed in the other country, although that would depend on that country's rules. One, I guess, particular case that we often see is with France, and they do actually have an anti-remittance basis rule. So if the money is not taxed in the UK under the remittance basis, then it would be taxed in France. But you would have to look at each country individually to see what their rules are. Should we look at the next question? If an employee coming to the UK gets an accommodation benefit, would that need to be declared on the P11D? Charlotte, can you answer that?
So obviously without all the details, it's hard to answer that question relating to someone specific, but if an employee is coming to the UK and they are receiving an accommodation benefit from their employer, then usually benefits would need to be declared on the P11D. There may be relief available on accommodation benefit depending on how long that individual is planning on being in the UK for and how long their assignment is for. If that accommodation benefit is taxable, then going back to the point we had about benefits, overseas workday relief can maybe be claimed against that accommodation benefit if cash is paid outside the UK throughout the tax year to ensure that there's been enough cash paid to cover that. There may be, as I said before, relief available, and this will be covered in our next webinar on temporary workplace rules. And so if this is a question that you're interested in, then please do join our next webinar, and you can get the information from the next webinar, and hopefully that will help you on that question.
So I think that's all we've got time for today. As you can see on the screen, and as Charlotte just mentioned, our next webinar will be on temporary workplace rules, and that's on Monday the 21st of May. If you have any questions on the overseas workday relief in the meantime, our contact details are on screen, so please feel free to contact us. Otherwise, we look forward to you joining us next time.